When markets get wild, when prices move like they've lost their mind, most traders don't get rich, they get wrecked. And the irony is, volatility should be opportunity. But for most, it becomes exposure of every weakness they've been hiding under quiet markets. You can tell who's actually a trader and who's just been lucky when the charts start shaking. Because when volatility hits, luck burns off fast and only discipline stays standing. See, volatility isn't chaos, it's a mirror. It shows you exactly who you are. Every impulsive decision, every little greed-driven click, every fear-based sell-off, magnified. It's the moment the market stops rewarding mediocrity. During low volatility periods, even bad traders can look smart. Their strategies work because the market isn't testing them. It's like floating in a calm pool thinking you can swim until a wave hits and you realize you never learned how to breathe underwater. The first big reason most traders lose during volatility is because they think they're adapting when they're actually reacting. There's a huge difference between the two. Adapting is measured, strategic, controlled. Reacting is emotional, immediate, desperate. Volatility triggers the survival part of your brain. It whispers, do something. Your screen flashes red, your heart rate spikes, your palms sweat, and your rational thinking quietly leaves the room. You start chasing reversals, doubling down on losing positions, moving your stop losses too close, or worse, removing them entirely. In short, you start negotiating with chaos, and chaos doesn't negotiate. Here's something most people never admit. Volatility exposes how addicted traders are to feeling in control. Every trade gives you a little hit of certainty. You click buy, and for that second, you feel powerful, like you've made the right call. But volatility shatters that illusion. Suddenly, the same action that used to feel like control now feels like helplessness. You're no longer deciding what to do, you're reacting to what the market is doing to you. And that's when losses start stacking. Because the truth is, volatility doesn't destroy traders. Their illusion of control does. The second reason most traders lose is because they never redefine what normal looks like. When volatility spikes, the market's rhythm changes. Candle patterns stretch, correlations break, volume surges. But most traders keep applying the same rules they used during calm conditions. They use the same position sizes, the same stop distances, the same setups. It's like driving on an icy road at summer speeds. You're going to crash, even if your car is the best on the street. Market conditions demand recalibration, and yet few traders have the humility to admit that their strategy was never built for turbulence. They keep playing checkers while the board's on fire. Now, let's talk about the psychological storm volatility creates. Fear and greed don't just appear, they fuse together. One minute you're terrified of losing everything, the next you're chasing every single green candle like it's salvation. It's emotional whiplash. You start trading on instinct, but it's not intuition, it's anxiety dressed up as confidence. And here's the dangerous part. Sometimes you win a few trades like this. The market throws you a bone. You feel sharp, validated. You think, I've cracked it. But that's not skill, it's survival bias. The same habits that made you lucky in one move will destroy you in the next. Because volatility rewards patience and punishes arrogance. Always. You know what's even worse? Many traders think they can outsmart volatility by sitting it out. But they don't actually sit out, they hover. They keep refreshing charts, waiting for a signal that feels safe. But there's no such thing. They're mentally in the market even when they're not physically trading. So when they finally jump in, it's not a decision, it's an emotional spillover. They haven't been waiting, they've been simmering. And volatility feeds on that kind of energy. It punishes hesitation as much as it punishes impulsiveness, because both come from the same place, emotional imbalance. Another major reason traders lose is misunderstanding risk in volatile conditions. Most people think of risk as a fixed percentage. I'll only risk 1% per trade. But volatility changes what 1% means. A 1% risk in a calm market might be manageable. In a volatile one, it can become 3% or 5% before you even blink. The problem isn't the percentage, it's the assumption that the market will behave predictably enough for that percentage to matter. Volatility makes markets non-linear. Price doesn't move smoothly anymore. It jumps, skips, gaps. The concept of tight control becomes fiction, and those who rely on it as truth end up losing faster than they can adjust their stop loss. Then there's ego. Every trader thinks they'll be the exception, that when others panic, they'll stay calm, that when others sell, they'll buy. But ego and volatility are like oil and fire. They explode together. Volatility doesn't care how confident you sound in your trading group. It doesn't care about your streak or your screenshots. It just finds your weak spot, your overconfidence, your denial, your refusal to take a loss, and widens it until you break. And when you break, you don't just lose money, you lose perspective. You start revenge trading. You start thinking the market owes you something. That's when the spiral begins, the one no risk management system can save you from. Let's pause for a moment here and zoom out. If you strip away all charts, indicators, and noise, volatility is really a test of two things: emotional resilience and adaptability. The market doesn't reward knowledge as much as it rewards nerve. You can have all the right setups and still lose everything if your mind isn't stable when uncertainty hits. Because volatility amplifies emotion faster than it amplifies price. It's not just about knowing when to enter or exit, it's about knowing when not to touch the mouse at all. Think about the best traders, the ones who actually thrive in volatile times. They don't move faster, they move slower. They wait. They let everyone else exhaust themselves trying to time the chaos, and then they step in when the emotional noise dies down. They aren't calm because they don't feel fear. They're calm because they've made peace with it. They've accepted that volatility is part of the game, not an interruption of it. That's a completely different mindset from the average trader, who treats volatility like an unwanted guest instead of the main event. But maybe the most painful truth is this: most traders lose during volatility because they can't handle stillness. They confuse movement with progress. They feel like if they're not doing something, they're falling behind. So they overtrade. They force setups. They interpret every tick as a sign, every candle as confirmation. The market becomes a mirror for their restlessness. And volatility, in its cruel way, rewards patience and destroys impatience. It's almost poetic. Those who can't stop moving lose to those who barely move at all. There's a saying in trading: in calm waters, everyone's a captain. In storms, you find out who can swim. Most traders drown not because the waves are too big, but because they never learn to float. Floating means letting go of control when control isn't possible. It means trusting your preparation instead of your emotions. It means accepting that missing trades is part of staying alive. The traders who survive volatility are not the ones who predict it. They're the ones who respect it. And that's where the real game begins, when you stop trying to master the market and start mastering yourself. Because at its core, volatility doesn't just shake prices, it shakes egos, beliefs, and illusions. It takes everything unstable in you and makes it visible. And once you see it, you have two choices: confront it or keep pretending it's the market's fault. The truth is, volatility doesn't just expose weak traders, it exposes weak identities. Most people trade to prove something, to themselves, to someone else, to the world. They attach their worth to their wins. They take a green day as validation and a red day as humiliation. So when volatility comes and rips through their portfolio, it's not just their account that's bleeding, it's their self-image. They don't know how to separate a losing trade from being a loser. And that mental confusion is deadly, Because once emotion fuses with identity, you stop trading objectively. Every loss feels personal. Every move against you feels like betrayal. The market becomes an enemy, not a system. And when you start seeing the market as your enemy, you've already lost. Because now you're not trading price, you're trading vengeance. You're no longer thinking in probabilities, you're chasing justice. And the market will always punish anyone who expects fairness. That's what volatility does best. It exposes who's trading out of revenge instead of reason. You can spot these traders instantly. They increase their position size after a loss, they refuse to close bad trades because it'll come back, and they measure success by recovery, not risk control. What they don't realize is volatility isn't a storm you fight, it's a tide you learn to move with. The more you fight it, the deeper you sink. Here's the paradox. Volatility actually favors the disciplined. When markets are calm, discipline feels like overkill. It feels boring, almost unnecessary. You can make money being sloppy. But when volatility spikes, discipline becomes your only weapon. The traders who've trained themselves to act mechanically, to follow process over impulse, suddenly find that what used to hold them back now saves them. It's not the genius traders who win during volatility, it's the boring ones, the ones who cut losses fast, the ones who size small when uncertain, the ones who know that surviving is winning. You see, most traders lose because they think they need to do something extraordinary when markets go wild. But professional traders think the opposite. They focus on what not to do. They reduce exposure, not increase it. They simplify their approach, not complicate it. They let other people overreact, because volatility rewards those who stay out of the noise. It's not about predicting where the market will go. It's about protecting yourself no matter where it does. Let's talk about something that almost no one mentions, the illusion of volatility being opportunity. Every influencer, every trading guru loves to say volatility is where the money is made. And yes, that's true, for people who know what they're doing. For everyone else, volatility isn't opportunity, it's temptation. It tempts you to chase the highs, to force trades that don't exist, to believe that you can make it all back if you just catch one big move. And that's how it traps you. The same volatility that made you feel alive for a moment slowly drains your account while convincing you that the next trade will fix everything. Volatility gives you a sense of urgency. It creates this illusion that if you're not acting now, you're missing out. But what you're really missing is the wisdom to wait, to understand that opportunities don't vanish, they cycle. There's always another setup, another swing, another play. But once your capital's gone, once your mental composure cracks, it takes a long time to rebuild. Most traders never make it that far. They burn out before they figure out that waiting is also a strategy. You might have heard the phrase, "Don't mistake activity for progress." That's especially true here. In volatile markets, activity feels productive. You're in trades, you're clicking buttons, you're watching candles form. It gives you the illusion of control, but it's fake progress. Because if you track those moments honestly, you'll see a pattern. The more you trade in chaos, the more inconsistent you become. You start breaking your own rules. You justify it by saying, these are unusual conditions. But that's the point. Real traders have rules for unusual conditions too. It's called preparation. Everyone else improvises, and improvisation is just panic disguised as creativity. Let's go deeper into what happens in your mind during these moments. Volatility short-circuits your prefrontal cortex, the rational part of your brain. Instead, your amygdala takes over, the fear center. It doesn't care about analysis, it cares about survival. It interprets red candles as threats and green candles as safety signals. That's why you FOMO buy tops and panic sell bottoms. It's not stupidity, it's biology. The market isn't just testing your skills, it's hijacking your nervous system. And unless you've trained your mind to stay detached, you'll keep falling into the same patterns. You'll keep telling yourself, next time I'll stay calm, until you're right back in the same spiral. And that's why the best traders don't rely on willpower. They rely on systems. Willpower is emotional. It fluctuates. Systems are structural. They protect you from yourself. For example, they decide in advance how much to risk, when to stop, what to trade, and under what conditions. When volatility hits, they don't have to think. Thinking is where fear sneaks in. They just execute. That's why consistent traders seem emotionless. They've built habits that replace emotion with process. Meanwhile, most retail traders still believe they can feel the market. But volatility is not something you feel, it's something you measure. And here's a brutal truth most won't like. If you need the market to move for you to feel alive, you're already done. Because that means you're not trading for profit, you're trading for stimulation. Volatility then becomes your drug, not your challenge. And every drug ends the same way. Temporary highs, long-term destruction. The best traders are boring on purpose. They treat trading like math, not magic. They don't need thrill, they need precision. Another thing most traders overlook is context. Volatility doesn't exist in isolation. It's part of a bigger story. Maybe it's driven by earnings, by macro shifts, by liquidity drying up. Most traders ignore that. They stare at charts like fortune tellers, hoping for meaning in patterns. But volatility isn't about patterns. It's about psychology on a mass scale. It's millions of people reacting at once, their emotions feeding off each other. When you understand that, you stop trying to predict individual moves and start studying crowd behavior instead. That's where the real edge lies, not in knowing what the price will do, but in knowing how people will respond to what it does. It's like this. The market isn't trying to trick you, it's trying to test you. Every fake breakout, every sudden reversal, every flash crash, it's all a test of your ability to remain unshaken. If you treat every fluctuation as information instead of provocation, you start to see the structure within the chaos. You start realizing volatility isn't random, it's rhythm. A violent rhythm, yes, but one that rewards those who can dance without losing balance. And balance, that's the word most traders forget. They spend all their time optimizing entries, chasing indicators, backtesting strategies. But they forget that no system works without psychological balance. Volatility exposes imbalance like nothing else. It shows whether you can hold your emotions steady when everyone else is screaming, whether you can act small when your ego wants to go big, whether you can let go of a loss without trying to avenge it. Those are the real skills. Everything else is just noise dressed up as technique. Volatility doesn't make traders lose. It just shows who's been pretending all along. The cruel irony is, volatility doesn't just test your strategy, it tests your story. The story you've been telling yourself about who you are as a trader. Every trader walks into the market carrying a personal narrative. I'm disciplined, I'm smart, I have an edge. But when volatility arrives, it tears that story apart and asks, prove it. Most can't, because their confidence was built on a market that was forgiving, not on one that was honest. And volatility is brutally honest. It doesn't care how many books you've read, how many charts you've drawn, or how many motivational quotes you've saved. It only cares whether you can think clearly when everything else starts moving faster than you can process. And that's where most lose, not in the trades themselves, but in the time compression. Volatility speeds everything up. Information, emotion, execution, they all collapse into smaller windows. You're forced to decide faster than your rational mind can keep up. So what do most traders do? They default to instinct. But instincts in trading are unreliable unless they're trained. Untrained instinct is just emotion in disguise. It's the same impulse that makes people run toward a crowd during panic because they think if everyone's doing it, it must be right. That's herd behavior, and volatility thrives on it. Watch any market crash or sudden rally. The first thing you'll notice is not the price, it's the panic. Everyone thinks they'll stay rational until they see others losing their minds. And suddenly, logic feels like a luxury. You start thinking, maybe they know something I don't. That's the trap. The moment you start trading based on what others might know, you've stopped trading based on what you understand. And once that happens, you're no longer a participant, you're prey. Volatility feeds on collective uncertainty. It amplifies fear into movement and movement into mistakes. That's why emotional detachment isn't just a virtue, it's survival. But detachment doesn't mean apathy. It means your decisions are unaffected by the noise around you. It's the calm inside the hurricane. The best traders don't ignore volatility, they internalize it. They understand it's not a signal to panic, but a signal to observe. They let others overextend themselves while they study the pattern forming beneath the chaos. Because beneath every violent move lies the same principle: human emotion, expressed through price. Most traders think volatility is about the market acting crazy. It's not. It's about the market revealing how crazy people become when uncertainty takes over. Every candle, every spike, every reversal, it's just emotion on display. Fear of loss, greed for gain, the desperation to be right, the refusal to accept pain. You can almost read it like a psychological map. When you start seeing it that way, you stop being surprised by volatility. You expect it. You prepare for it, and preparation turns panic into patience. But here's something even deeper. Volatility also reveals your relationship with uncertainty. Most people hate not knowing. They crave predictability. That's why they chase indicators, algorithms, strategies, anything that promises certainty. But the truth is, markets are built on uncertainty. Volatility is just uncertainty showing its face. So the traders who can't coexist with it are fighting the very nature of the game. You can't master trading without mastering uncertainty. You can't demand control from something that was never meant to be controlled. The best traders don't predict, they position. They place themselves where probability favors them and accept that the rest is noise. There's another layer to why most traders lose: fatigue. Volatile markets drain you mentally. They keep you alert for too long. You're glued to screens, heart pounding with every tick. You can't relax because you think the moment you look away, you'll miss something. That constant vigilance slowly erodes your judgment. You start making micro decisions, tiny emotional adjustments that compound into huge errors. Fatigue doesn't just make you tired, it makes you reactive. It lowers your threshold for rational thought. So even if your plan was perfect in the morning, by the afternoon you're improvising again. And every improvisation during volatility costs you something: money, confidence, or both. This is why the best traders treat rest as part of their edge. They know the human brain isn't built for constant stimulation. They step away not because they're scared, but because they're strategic. They protect their decision-making capacity like capital. And that's what most traders never understand. Discipline isn't just about sticking to a plan. It's about protecting your mind so the plan can actually work. Then there's the concept of emotional memory. Every loss during volatility leaves a mark. It doesn't just fade, it shapes your behavior in the future. If you took a massive loss once, your subconscious starts associating volatility with pain. So even when a real opportunity shows up, you hesitate, you freeze, you second guess. And hesitation in volatility is just as dangerous as impulsiveness. You miss the move, then chase it, then regret it. The loop continues until your emotions are completely detached from reality. You're not trading the market anymore, you're trading your trauma. And that's why mastering volatility isn't about market analysis, it's about emotional awareness. You have to know what part of you is reacting before it reacts. You have to recognize the moment your emotions shift from alertness to anxiety. Because if you catch it early, you can pause. But if you don't, you're gone before you even realize it. Volatility doesn't destroy traders in one move. It wears them down over time. It's death by 1,000 micro-reactions. Here's something people rarely admit. Volatility often exposes that most traders were never investors. They were gamblers with better vocabulary. They called it scalping, swinging, position sizing, but what they were really doing was betting emotionally, not strategically. The moment the odds turned against them, they couldn't stop. They needed to feel right more than they needed to protect their capital. That's not trading, that's ego maintenance. And volatility eats egos for breakfast. The market doesn't punish you because you're wrong. It punishes you because you can't accept that you're wrong fast enough. You cling to trades because you're clinging to identity. You double down because you want to fix the feeling of being wrong, not the position itself. It's emotional damage control disguised as strategy. And when you're in that state, volatility isn't your enemy, it's your mirror. It reflects every unresolved emotion back at you in real time. That's why it feels so brutal, because it's showing you exactly what you've been avoiding. And the saddest part? Most traders don't learn. They move on to the next setup, the next ticker, the next market cycle without ever confronting the real issue. They keep refining strategies instead of refining themselves. They think changing indicators will change outcomes. But volatility doesn't care about your new setup. It only cares whether you've evolved emotionally. The same trader mindset will create the same losses no matter what chart you're on. The truth is, volatility isn't your problem. Your reaction to volatility is. And that's the paradox every trader eventually faces. You can't control volatility, but you can control the version of yourself that meets it. Every spike, every dip, every fake out is like a mirror held up to your inner state. If you meet it with panic, it multiplies. If you meet it with calm, it slows down. Because here's the truth most people never realize. Volatility only feels violent when you're inside it emotionally. Once you step outside, mentally detach, you see it differently. You start noticing patterns in behavior, not just price. You see the waves, not the water. But detachment isn't natural, it's learned. It's built through repetition, losses, reflection, and, most importantly, honesty. The kind of honesty that forces you to admit that maybe you didn't lose because the market was unfair, but because you were unprepared. Volatility exposes that. It reveals who was trading to grow and who was trading to escape something. Because the truth is, most traders aren't chasing wealth, they're chasing validation. They want to feel smart, capable, in control. But the market doesn't give validation, it gives feedback. And volatility amplifies that feedback until it's impossible to ignore. Think about what happens when a candle suddenly breaks structure. Most traders freeze or chase. The disciplined few, those who've accepted that losses are data, not disasters, simply adjust. They don't judge themselves, they don't spiral, they just observe and adapt. That's the key difference between traders who survive volatility and those who vanish after it. One treats volatility as chaos. The other treats it as conversation, a dialogue between probability and psychology. When volatility hits, there are really only two games being played, external and internal. The external is what everyone sees, price action, news, movement. But the internal is where the outcome is decided. How long can you stay emotionally neutral while others are losing their grip? How long can you resist the urge to do something when doing nothing is the right move? That's the edge. That's where mastery lives. See, volatility doesn't reward knowledge, it rewards endurance. The ability to hold steady in confusion. The ability to be uncertain without collapsing into impulse. Every big player, every institutional trader, every hedge fund manager who survives volatility long term, they've learned this. Their systems are built not just to manage money, but to manage mind. They know that during volatility, the crowd stops thinking and starts feeling. And that's when opportunity quietly appears. Because while most traders are drowning in emotion, a few are watching how emotion moves price. They don't follow the candle, they follow the panic. They wait for exhaustion, for that moment when everyone who could panic already has. That's when volatility turns from threat to weapon. That's when calm becomes a competitive advantage. But calm isn't passive, it's preparation. You can't be calm during chaos if you never train for it in stillness. That's where most traders go wrong. They don't practice when it's quiet. They just trade. They don't journal emotions, they don't review behavior, they don't simulate stress. Then, when the real storm hits, they expect to stay composed through sheer willpower. But willpower isn't enough. You can't think your way through volatility, you have to condition your way through it. That's why elite traders talk about process like monks talk about meditation. Because it's not about predicting, it's about centering. Your process is your anchor. Without it, every fluctuation drags you somewhere new. But when you have it, when you've rehearsed what to do in both fear and euphoria, you stop reacting to every tick. You don't need the market to calm down for you to perform. You carry the calm with you. And this is where the most painful realization hits. Most traders don't fail during volatility because they're bad at reading charts. They fail because they're bad at reading themselves. They think preparation is about technicals, but it's actually about temperament. They can handle price volatility, but not emotional volatility. Every spike in price triggers a spike in their nervous system. Every green candle triggers greed. Every red one, fear. Their strategy might be flawless on paper, but the human running it isn't. And that human, untrained, always loses to volatility. If you've ever felt that rush of adrenaline when the market suddenly moves against you, heart pounding, breath shallow, brain screaming, "Fix it," that's the moment volatility owns you. The worst part? You'll think you're thinking, but you're not. You're reacting. Every decision after that point is made by the same primitive wiring that once told your ancestors to run from lions. But the market isn't a lion. You can't outrun it. You can only outlast it. So what does outlasting look like? It looks like cutting trades without hesitation. It looks like trading smaller when uncertainty expands. It looks like not chasing every candle just because it moved. It looks like accepting boredom as a strategy. Because real power and volatility comes from patience, not prediction. The traders who last are the ones who know that not all motion is progress. They measure their edge not in wins, but in stability. Volatility punishes impatience, but it quietly rewards observation. It's teaching you, if you're willing to listen. Every failed trade is a lesson in discipline. Every emotional impulse is a mirror showing where you still need work. And if you can see that, if you can approach volatility not as threat but as training, you stop fearing it. You start using it. Because when others panic, volatility becomes profit for the prepared. Most people will never get there. They'll keep treating volatility as a storm they hope passes. But the best traders don't wait for calm seas. They learn to sail through the storm. They study it, they respect it, they adapt to it. They understand that the market's chaos isn't the enemy, it's the environment. The only enemy is the untrained mind that steps into it expecting peace. And that's the ultimate lesson. Volatility doesn't decide who wins, it decides who's ready.